Hello, it's Jessica with Made of Virtual Assistants, and it is such a gorgeous day out here. I know I've been doing all of my videos outside lately, but the weather has just been absolutely gorgeous and got to take advantage of it before the winter winds come and chase me inside. So here we are. We are here on Tuesday, so that must mean it's time for crypto tax tips on Tuesday. And I thought today I would talk about crypto income, possibly expenses. We'll see how long it takes, and how that impacts your taxes. So hopefully you know this by now, especially if you've watched any of our other YouTube videos or our Facebook Live videos or read any of our blog posts, but there's basically just a couple types of income for your crypto that it needs to be reported. And number one is your trades. So your trades are when you're buying and selling crypto, when you're exchanging a crypto for another crypto, especially if you're moving a crypto somewhere or something like that. Those are all trades. Trades are reported as capital gains. Capital gains are reported in two ways, at least in the United States, and that is there's the long-term capital gains, which you've held for longer than a year. Those get taxed at a lower tax rate. And then there's the short-term capital gains that you've held for less than a year. They get taxed at the ordinary income rate. So far that's pretty good. Okay, so that's capital gains, and we report that for the United States on the Schedule 8949, which feeds into your Schedule D, and it goes into all of your capital gains and losses. Okay, second major kind of income is the income you get when you're receiving a bonus for something. So sometimes you just get some income, and that can be for opening an account. There's certain networks on the blockchain that if you are active on there, they send you little bits of stuff. And guess what? Those little tiny bits that aren't worth even a penny still are supposed to be reported. So that's where you let the tax software handle it and import all of your transactions, and the little tiny bits get reported as a reward or a bonus or whatever. It kind of doesn't matter what you call them. They all basically feed into the same area of your taxes, which is there is the income that you earn from having crypto. There's also income that you get, which they call interest sometimes, or dividends, which might need to be reported in a different area of your taxes. Still gets taxed the same way. And it's because you're holding crypto, but this might be in an earn program. If you deposit some Bitcoin and you get a little bit of Bitcoin back every day as interest income, that sometimes needs to be reported in a different place. Okay, I feel like I'm repeating myself a lot, but that's okay. Well, then there's other kinds of income that are more interesting. So there is mining income. If you go out and you buy the mining rig and you set it up in your house and you're doing the mining thing, that is often considered self-employment income for U.S. taxes. And what that means is that you would report that in yet a different place on your taxes, usually on Schedule C. And what that means is that it is subject to self-employment taxes. So the other kinds of income that you can earn from crypto are taxed at your ordinary tax rate. The mining income is actually taxed at your ordinary income rate, and then you have to pay self-employment taxes, which is usually another 15% on top of that. But the thing about self-employment taxes is because you are doing it as a business, you actually do have the opportunity of deducting costs like your electricity usage for the mining operation, like purchasing the mining rigs and hardware and things like that. So because of that, depending how much you're making from the mining, it might not matter, but a lot of people will actually put their mining earnings into a corporation structure. That means that it doesn't have to pay that self-employment tax, because if I report mining income and it feeds onto my individual self-employment, then I have to pay the 15% extra taxes. But if I set up some kind of corporation and the corporation gets taxed at a certain rate, then I take a distribution from it instead of getting the money directly. And in that way, I would still pay taxes on my portion of the distribution. This is where you need to talk to a specialist, actually, because they can tell you how to structure this correctly so that you don't get double taxed. Because what I am saying right now is coming out sounding like you're going to get double taxed, but I don't think that's how it works. Actually, I'm not sure distributions from a business are taxed. Like wages, like if you're paying yourself a salary, that is taxed, but that would also be a business expense, so it would be reducing the amount of income you need to report, and yeah, somehow it all works out. Okay. We've covered capital gains, and we've covered rewards and bonuses, interest, mining. There are also opportunities to rent out your NFTs and things like that, which can be very interesting. Depending on what kind of NFT it is and the structure of that could be subject to self-employment tax, I've heard, but you would definitely need to talk to an expert about that. I think that's pretty much it for income. But then there's the liquidity pool stuff. So then there's this category of income where if you deposit money into a protocol and you get that money back out. So there's so many protocols, especially in DeFi, where you combine two coins together and you deposit it into this, what's called a liquidity pool. And that does something. The liquidity pool provides a place for other crypto investors to borrow from. So they take some of your coin and the other coin and they pay you a little bit of interest for borrowing it. And then at the end, you pull out your liquidity pool token and supposedly you're supposed to get more back than you put in. I haven't seen it always work that way, but that is the goal. And those sorts of transactions get pretty complicated, but some of that is a return of capital. So you definitely want to make sure if you're doing your crypto taxes on your own with crypto tax software, the crypto tax software knows how to handle the trades. No problem. Easy peasy, especially if the trades are happening in one exchange. Not so easy if they're happening between two wallets, then you have to kind of mess with it. So the crypto tax software knows how to handle trades. The crypto tax software sometimes, hopefully, know how to label the things that come in that aren't trades as income. This is where you want to make sure that your crypto tax software has your entire history, because you don't want things coming into your account being labeled as income that were actually transfers from another account you had somewhere that you forgot to add to your tax software. So this is something we're always helping our clients with, is helping them figure out where they stashed all their crypto, and if they're moving it around, making sure that the story of the crypto is being told correctly in the tax software. Because you definitely, if you move $5,000 in from an exchange you forgot to add, you don't want that as income. That would increase your income by $5,000, which is taxed at the short-term rate. So you definitely don't want to do that. Then with the liquidity pool tokens, with the mining's pretty easy. You just need to make sure it's labeled mining, and it'll spit out usually to the correct report. If your tax software actually covers reporting income, you do need to check that. Some of them do not. And technically you are supposed to report all of your income. So that's kind of a little bit of a problem for those taxpayers who aren't paying attention, if the IRS should ever come after you, which who knows. And then the liquidity pool stuff gets really complicated when you've got things coming in, going out. Some of it's coming back as interest or earnings, and it should be labeled as earnings. Some of it is coming back as a return of capital. Sometimes you get your money back throughout the deposit. So like if we deposit drip tokens into the drip faucet and we get tokens back, that is a return of capital. That is not income until you have more coming back than you originally put in, which I believe they're restructuring the protocol, so that is never going to happen, but there you go. And then sometimes the funds come back that you deposited at the very end. So if you deposit into a liquidity pool, for instance, and it sits there for a while and then it comes back. So you would report that coming back at the end as a return of capital. And if it's increased or decreased at all, then you would have some sort of trade or something to show those changes. So that is pretty much it for income. For expenses, there are expenses that also need to be reported on your taxes, and most of them won't be deductible, but there are trading fees. Trading fees are usually included as part of your trade, and they become part of your cost basis and the amount you receive and all that sort of thing. So usually you don't have to worry too much about that. When you're moving crypto around, you usually do have to pay withdrawal fees and transfer fees and things like that. Those are not technically reportable for US investors, although I hear Canadian investors can report those as part of their expenses. If you're running your crypto investing as a business, it's probably easier to report those sorts of costs as expenses and all that sort of thing. So there's withdrawal fees, and then there's any expenses you spend offline. If you are investing in courses on learning how to invest in crypto, or if you are investing in software that is helping you trade, those could be part of your expenses. And if you're set up to report your crypto investments as a business, then you can deduct those expenses against some of your earnings. However, most people, I think, need to reach a certain income limit and report it on their, it used to be a Schedule A, where you would report all of your investing expenses and things like that. And if you have a low enough income, that can be beneficial to you, but I'm not sure anyone has a low enough income to really take advantage of that. So expenses like offline, probably not going to help you unless you structure your investing in a smart way, which can be beneficial. And then anything else that you might pay expenses for, like, oh my goodness, there are so many expenses and fees that get paid when you're participating in one of these protocols where you have to like rehydrate or reinvest or whatever like that. Those little bits do add up. Hopefully you're doing it on a network that doesn't charge too much money. Those are some expenses, most of them not really helpful for a normal average US taxpayer. Being smart about it though can be a good thing. If you can set up your trading in something like a Roth IRA where you don't have to pay any taxes, that can be really beneficial. Or if you can set up your trading and crypto things in a business account, that can be good and it can be bad, because business accounts I don't think don't get the lower long-term capital gains rates that normal investors get. So sometimes it's a good idea to have the appreciation of the assets separate from the expenses and all the rest of that. Anyways, that's about all I can think of to say today. If you have questions, we are here Tuesdays and Thursdays at 4 p.m. Eastern. No matter what our little invite says for our invite, we are always here Tuesdays and Thursdays, 4 p.m. Eastern. We are here talking about crypto taxes, talking about investing and being smart with your crypto. And then on Saturdays at 10 a.m. Eastern, we like to take a deeper dive into investing strategies or being safe or things like that. We love questions. If you have a question about crypto investing or especially taxes, message us, email us, come visit our website or whatever. We do have a mini course, it takes you to the crypto tax matrix. We actually have been working really hard on our blog and our YouTube video channel. So if you're interested, come check it out. There's lots to see there. We're posting new stuff as quickly as we can get it cleaned up and reorganized and all that sort of thing. And we just have done something else. Oh, no, that doesn't matter. Okay, so I'm going to sign off for today and we'll see you again later. Bye.